Tax, demonetization and Donald Trump have taken a backseat. Good evening. Welcome to this special broadcast on CNBC-TV18. I'm Lata Venkatesh. With me, Surabhi Upadhyay.
Hello, Lata. Yes, the Nifty is negative for 2016. Not a great headline for the bulls for sure. We've erased all the gains. The Nifty is now at its lowest level in the last 7 months. And the mid-caps today have had absolutely no place to hide. And perhaps a lot of that can be blamed on the tax angle.
Exactly. Here's why the markets went into a tizzy today. In a speech delivered at a SEBI event in Mumbai on Saturday, Prime Minister Narendra Modi said those who profit from financial markets must contribute to nation building through taxes. On Sunday evening, Finance Minister Jaitley clarified, saying the Prime Minister's speech has been misinterpreted. He said there is no plan to impose long-term capital gains tax on securities. First up, let's hear out the two gentlemen.
Those who profit from financial markets must make a fair contribution to nation building through taxes. For various reasons, the contribution of tax from those who make money of the markets has been low. To some extent, it may be due to illegal activities and fraud.
The speech of the Honorable Prime Minister yesterday, with regard to all sections, including market players contributing to the national exchequer, the speech has been misinterpreted in some sections of the media, which have started speculating that this is an indirect reference to the fact that there could be long-term capital gains on security transactions. Now, this interpretation is absolutely erroneous.
Well, that clarification didn't quite help today. Now, tax fears have been looming in the market since last week. CNBC-TV18 reported on Thursday itself about a clarification from the Central Board of Direct Taxes that has fueled tax fears among foreign portfolio investors, particularly funds, India-based funds. So when will a foreign investor be taxed? Well, if investors owning more than 5% equity in the India-based offshore fund, he will be then subject to Indian taxation laws every time he or she redeems or transfers units of that particular fund. This is applicable to investors of all funds which derive more than 50% of their value from underlying Indian assets. The fund will deduct capital gains tax when the investor redeems the money. Now, the rates of taxation may be as high as 40% short-term capital gains and 20% for long-term capital gains in the case of unlisted private equity funds.
And that's not all. Another cloud looming is General Anti-Avoidance Rules, or GAR. They come into effect on April 1st. Will they override bilateral tax treaties and some of the space that those treaties allow? What about limitation of benefits? That phrase, the Mauritius Treaty has specific clauses that limit the treaty benefits. Will this extend to other treaties? These are the questions that are spooking investors at the moment. To discuss all these issues, joining us now are Mr. Dinesh, the CEO of Dhruva Advisors, corporate lawyer H.P. Raina, and Tejas Desai of Ernst & Young. Gentlemen, welcome. Mr. Raina, let me first start with you. First, what the FM and the PM said. The FM specifically clarifying that one need not worry about long-term capital gains tax. What should the market make of, therefore, the Prime Minister's statement that those who profit from the market need to contribute a fair share of taxes?
Well, what I look at it is that the Prime Minister wants some contribution, and possibly he is hinting at an increase in the security transaction tax, which may happen in this year's budget in 2017. But I think more than that, they want to plug some of the loopholes in the law. One of them, being for these penny companies which jack up the prices and then try to sell the shares and get the long-term capital gains exemption under Section 10 of the Income Tax Act. These are the loopholes which I think they are likely to be plugged. I don't think that the long-term capital gains tax structure is going to be touched at all in this year's budget. It will continue to have the exemption, but whoever misuses it by, having bogus valuations done, they will be brought to book and substantial penalties will be levied on them. This is what I see is happening in this Finance Bill 2017. Okay. Apart from that, certain things like bonus shares, when bonus shares are sold, the price comes down when bonus shares are issued, price comes down by 50%. Then the original shares are sold off and the loss is booked against the other capital gains. Those type of loopholes will be plugged. It is also possible you may reduce the carry forward period of 8 years, maybe from 8 years to 4 years. This is what I expect in this budget proposals.
Carry forward of what tax, what advantage?
No, carry forward of loss. Currently 8 years may be reduced to 4 years. The
Mr.
period
Kanabar,
for carry forward may be reduced to 4 years instead of 8 years.
Mr. Kanabar, your thoughts on the same question, sir? I mean, the market's big fear that we'll go back to long-term capital gains. So was perhaps one interpretation of what might happen, one interpretation of the Prime Minister's statement. What do you think could be likely scenarios and the possible interpretations?
We had this discussion earlier today also, and the point that I would just like to make is that there is a definitive move to say that people who profit from the stock exchange pay their fair share of taxes. We discussed that the fact of the matter is today, when you have a long-term capital gains tax exemption, that has been something which has been around. It has been a stated policy of the government. That policy has been around and sort of has provided a bit of a backbone and a certainty. And the question is, would the government want to rock the boat at this point of time? And the finance minister has himself clarified that he doesn't want to. I agree with what Mr. Raina stated, that maybe there are certain loopholes or certain advantages which are being taken off. And let me tell you, to my mind, you don't need to really amend the law to plug many of these loopholes. So, for example, the so-called penny stocks, where stocks are bought at a very cheap price and thereafter sold at a massive price, one only needs an investigation and a right approach, and the current regulations themselves are sufficient to take care of the entire thing. I think the point which Lata made earlier, which is more regarding general anti-avoidance regulations and how will they span out, is something to be remaining to be seen.
Okay. I'm coming back to you in a minute on how you have interpreted that anti-avoidance rules. Mr. Tejas Desai, let's go back to what was announced last week in terms of the indirect transfer clarifications. What are the limits of those clarifications? Who all should be worried?
See, I think if you look at that circular and the technical position that is articulated in that circular via the FAQs, and if you see, the thinking or the mindset of the tax administration that is reflected in that circular, I think it is going to cause genuine discomfort to a lot of investors. The circular, to my mind, is contrary to the general industry expectation that indirect transfer provisions do not apply to FII investments. There is a reason why those provisions were introduced. They were introduced to tax the Vodafone Hutch type of transactions, where there was a transfer of controlling interest in an Indian company. But when you have an FII which is selling Indian securities and is already taxed on its underlying transaction, and then the circular now seeks to clarify that it does not matter that you've been taxed at one level, you will again be taxed when the investor exits, I think that is going to cause a lot of discomfort to foreign investors. So,
Tejas, just a follow-up on that. The threshold that's mentioned, I mean, what one understood was that if you're an investor and you have more than 5% of the voting rights in this fund, or 5% of equity in this fund, only then do you have to worry. Is this threshold going to protect a large section of the investors in these offshore funds, or actually it will not, and therefore most funds and most of the fund investors need to worry?
So that is one carve-out which is clearly there in the law, but that is not enough. So in the context of fund structures, you could have multi-tier structures. And, there are good reasons why those structures are put in place. You may have an India sub-fund, which is a subsidiary of a larger emerging markets fund, because you want to create another India fund for India investments. And in those situations, the carve-out of 5% is not going to help. So there is still going to be double taxation.
Okay. Mr. Raina, your thoughts on this issue itself, indirect transfer, who all will be affected. My sense was that private equity investors will be the most affected. What will be the tax leviable for a private equity investor who similarly sees an indirect transfer impact?
Yeah, private equity investors certainly will be impacted. And I think there needs to be some clarity which will be brought in this Finance Bill 2017. So I'm hopeful that this will be clarified, what will be the rate and how the assessment is going to be made. But Lata, I also want to deal with the other issue which you raise about GAR and double tax avoidance agreements. My own view is that double tax avoidance agreement is between two sovereign countries, India and whichever country it has entered into, and those prevail. In other words, the general principles of the Income Tax Act, GAR, will not override the treaty provisions. The treaty provisions will prevail. And that is an important principle of law which has been set out by the Supreme Court on several occasions. So we don't have to worry on that aspect.
Okay. Weren't we expecting that the income tax authorities will issue some clarifications in the run-up to April 1st, Mr. Kanabar?
So just two comments. First is a point which Mr. Raina just made in the context of interplay between treaties and GAR. Unfortunately, the Income Tax Act, where the GAR provisions have been introduced, expressly states that it will override any provisions of the tax treaty which India has entered into. As you know, in our case, the power to enter into tax treaties is conferred on the legislature on account of Section 90 of the Income Tax Act, and this is a specific carve-out, and therefore the law permits such an override. And unfortunately, representations have been made to the CBDT to clarify that wherever there is a limitation of benefit, those will be sufficient thresholds to get tax treaty advantages, and the CBDT has gone on to say, no, we do not believe so. In fact, the government constituted a committee which was under Dr. Parthasarathi Shom, and the Shom committee recommended that specific anti-avoidance regulations, when complied with, should not be subjected to general anti-avoidance regulations, including in the context of tax treaties, and the government has gone back to say, no, we do not agree. So that's one part. Tejas earlier mentioned regarding the circular and the issues out there. At one level, Lata, the circular merely states what the law is. The unfortunate part is that the law was looking stark out there, and representations were made to say that this does not make sense. An overseas entity and an overseas investor via an entity being subjected to tax in this particular manner is not appropriate. And what is very starkly worrying about the circular is the vehemence with which it reiterates what the law always is. They might have as well kept quiet about it, but all that they are saying is, read the law, this is what we mean, and we are going to tax you. So the tone and tenor of this circular is inconsistent with how we have seen the tax office approach taxpayers in the recent past.
Okay, and when you fix this clarifications from the tax department with the overarching ideological statement, if you please, from the Prime Minister, that those who profit from the share market ought to contribute more to the common good, then everything seems to take, the macro and the micros are in place for higher taxes, which perhaps is what has spooked the market. We have lots more questions for you three gentlemen. We have to take a break, but we will continue this discussion in a jiffy.